Silver just proves something that should terrify anyone still pretending abundance is guaranteed. During dead holiday volume, price didn't drift. It exploded in Asia, then got hammered in swings so violent they looked intentional, like someone testing how much chaos the structure could absorb before breaking. And while traders obsessed over candles, the actual shift happened in silence. Governments and industrial giants are now treating silver like a weapon-grade input, not a collectible. This isn't about silver going up. This is about the physical pipeline collapsing while the paper system pretends everything still works. That gap is where the danger lives. Start with what the noise hides. When price moves, amateurs scream bubble or crash. But the real signal isn't the move. It's who changed their behavior because of it. And behavior is changing now. China is choking off silver flows. The U.S. reclassified it as critical infrastructure. Manufacturers are locking down future supply like they expect war, not markets. That's not hype. That's procurement in survival mode. Here's the error everyone makes. They think silver is one market. It's two. There's the paper layer where infinite contracts trade like air. And there's the physical layer where metal has to exist, move, clear, and actually show up. Paper can print claims forever. Physics can't print atoms. So when the two markets disagree, we don't debate which chart looks cleaner. We ask who has to deliver. Because delivery is the only referee that matters, and delivery always wins. Now what happened this week? Silver ripped during Asian hours, hit a fresh nominal high, then got slammed with selling that felt less like profit-taking and more like a controlled detonation. If you've ever watched a stampede start from nothing, you know the feeling. 1 second, it's calm. The next second, it's violence, and everyone pretends they weren't involved. That's what this tape looked like. And here's why it matters. This kind of action, especially in thin liquidity, doesn't show speculation. It shows stress in the machinery. So let's check the machinery. One of the loudest signals in any commodity surge is when futures participation doesn't rise with price. In a normal speculator rally, open interest explodes. Gamblers flood in. Leverage stacks. The market turns into a crowded elevator. But when price climbs while open interest stays flat or fades, it tells you something different. Shorts are retreating. Weak hands are being eliminated. And the move isn't paper excitement. It's physical pressure. That matters. It means this isn't a party. It's a squeeze in slow motion. Now add the inventory collapse. Across every major Western vault, the publicly tracked available stockpiles have been draining. The labels vary by exchange, but the pattern is identical. Metal that can be pulled is being pulled. And when pullable supply shrinks, the market's ability to absorb gain shrinks with it. Because if you can't source bars easily, you can't settle problems easily. You can only postpone them. And postponement is where squeezes ignite. Before anyone gets reckless, separate fact from interpretation. Fact: monitored inventories have been drawing down for months. Interpretation: that drawdown raises fragility and makes maintaining short positions exponentially more expensive. That's the certainty ladder. We don't predict. We measure what's already broken. So why are inventories under stress? Because silver demand isn't one story anymore. It's multiple mega trends stacked like weights on a bar. Data centers, AI infrastructure, electrification, solar scaling, onshoring, grid hardening, defense systems, batteries. Every single theme touches silver, sometimes directly because silver conducts better than anything else at scale, sometimes indirectly because silver lives inside the connectors and control modules that make modern infrastructure possible. People argue about grams per device. They miss the forest. This isn't one device. It's an entire industrial base rewiring itself in real time. Silver doesn't need a perfect storm. It just needs the storm already here. Now let's talk about the supply war. Call it competition. Call it national security. Call it whatever makes you comfortable. The label is irrelevant. The behavior is everything. Countries want control over inputs. Corporations want certainty over raw materials. And both are willing to weaponize capital to get it. That breaks the old model. Old model: price is low, supply is abundant, buyers are passive. New model: supply is constrained, buyers panic, and panicked buyers rewrite the rules. You see it when export restrictions appear. You see it when critical material lists get updated overnight. You see it when capital floods into mining projects, not because mining is profitable, but because mining is a choke point. Here's a concrete signal. When a manufacturer buys equity in a mining project and locks down future output, that's not a trade. That's supply chain warfare. They're announcing to the market, we don't trust you to be there when we need you. And once industrial buyers start thinking that way, the market stops flowing like a river. It becomes a series of dams. And dams don't leak. They break. Now go east. China is the gravitational center of industrial metals demand, not because of narratives, because it builds the products the world depends on. If domestic stockpiles are tight relative to manufacturing needs, then any policy move to prioritize domestic supply becomes a shockwave. It tells you one thing: they're not preparing for abundance. They're preparing for scarcity. And when the country at the center of global manufacturing chooses itself first on a strategic input, the ripple hits everywhere. The same bar gets bid by more buyers. Premiums appear. Delivery times stretch. And the paper price becomes fiction. Now premiums, because this is where reality breaks through the noise. Premiums are the voice of the physical market. They don't lie. If buyers are paying over spot to lock supply, that doesn't mean price moons tomorrow. It means metal is harder to source at this price today. And when you hear reports of overseas buyers calling producers with serious premiums attached, that's not technical analysis. That's desperation. Procurement is ruthless. Procurement doesn't care about your trend lines. Procurement cares about not halting a production line. If a factory stops because one small input vanished, the cost is catastrophic, so they pay. That's why small premiums can be the tremor before the earthquake. Now watch the contradiction keeping everyone confused. The mainstream story says the dollar only slipped slightly, but measured against hard assets, purchasing power collapsed far more, because inflation isn't one number. It's a battlefield. Some prices drift, some explode, and the things tied to real physical limits, energy, metals, logistics, show the truth first. So if your income stayed flat in nominal terms while metal prices surged, you didn't fail. The measuring stick bent. That's why people feel insane. They're told the problem is minor. Then they experience the problem as existential. Here's where we stay disciplined. Price in a bull market can still destroy you. Silver is notorious for it. It sprints like a thief, trips an alarm, then sprints again. It doesn't climb stairs. It climbs a ladder in a hurricane. So what do? We don't gamble. We position. And we separate time horizons. Short term, volatility murders leverage traders. Medium term, physical tightness applies constant pressure. Long term, structural demand can reprice the entire asset. If you're glued to the 1-minute chart like it's life support, you'll panic. If you're watching the structural picture, you'll see something else. Let's revisit the Western Vault tension because this is where the fracture grows. When monitored stockpiles shrink, lease rates climb. And rising lease rates signal metal is getting expensive to borrow. That matters because the bullion system runs on borrowing. It's a carry trade, a supply chain, a web of use. When borrowing gets costly, the chain tightens. When the chain tightens, tolerance for short games evaporates. And when tolerance vanishes, you get violent dislocations. Not because of Reddit, because of math. Now the other white metals, platinum, palladium, because they're confirming something. When multiple related metals surge simultaneously, it signals broader stress in the complex. Industrial demand, substitution pressure, constrained supply, or all of it. And when a metal like platinum can whipsaw wildly in a single month, it exposes a truth. These markets are thinner than anyone admits. Thin markets don't need headlines to move. They need imbalance. An imbalance is appearing with accelerating frequency. Now the EV story, carefully, because hype and reality are tangled here. Claims float around about silver content per battery. Some exaggerated, some plausible in niche designs, some pure fiction. We don't need the extreme number. Here's the sharper frame. Even modest increases in silver use per unit, multiplied by industrial scaling in the billions, moves demand in a metal already running tight. 1 gram times 1 billion units is a mountain, and modern manufacturing operates in billions. That's the frame. So when a technology shift increases silver use slightly, don't dismiss it. Ask how big the scaling curve is, because scaling is where hidden demand detonates. Now the U.S. calling silver critical. When something gets that label, it's a policy bomb. It means supply risk is acknowledged at the highest levels. It means domestic sourcing becomes politically mandatory. It means stockpiling becomes probable. And it means competition for supply intensifies, not overnight, but relentlessly. And relentless pressure is exactly what turns normal markets into stressed markets. Here's the retention wedge. If silver is just a commodity, why are governments acting like it's strategic ammunition? And if it's just a store of value, why are manufacturers scrambling to lock it down? Which is it? It's both. And that dual nature is why this setup is lethal for shorts and critical for anyone watching physical flows. A metal that's both monetary and industrial has two demand engines. When one cools, the other can still accelerate. That's not a price guarantee. It's structural resilience in a world where resilience is vanishing. Now, sentiment whipsaw. This week delivered the classic pattern. Surge triggers headlines. Drop triggers fear. Conversation splits into two tribes. Tribe A says it's over. Tribe B says it's beginning. Here's what we do. We don't pick tribes based on feelings. We stack signals based on evidence. Signal 1. Policy moves restricting or prioritizing supply. Signal 2. Manufacturers locking mining exposure. Signal 3. Monitored inventories draining. Signal 4. Physical premiums and borrowing costs rising. Signal 5. Violent paper volatility during thin liquidity. When signals stack, odds of a sustained structural breakout increase, not certainty. Odds. Now the celebrity effect, because it's real. When a major public figure amplifies a commodity narrative, attention shifts. Attention shifts flows. Flows shift price, especially in thin markets. But attention is a match. Structure is the fuel. A tweak can ignite something. Only tightness keeps it burning. So if social chatter explodes, don't assume that's the cause. Assume it's a spotlight. Then hunt for underlying fuel. Supply, demand, inventories, premiums. That's how we stay rational. And if you're considering metals allocation, one rule we never break. Don't use leverage you can't emotionally survive. These aren't smooth markets. These are markets designed to test conviction by attacking your nervous system directly. Takeaways we actually need. First, silver is being pulled in two directions simultaneously: monetary demand and industrial demand. That makes its supply balance hypersensitive to shocks. Second, policy and corporate behavior are shifting towards supply capture, tightening the pipeline before the public even notices. Third, monitored inventories and borrowing signals prove the physical side is nowhere near as loose as the paper side pretends. Fourth, volatility isn't proof the story is dead. In silver, volatility is often the entry fee. That's it. We don't need 20 points. We need the correct 3. Now what to watch next, because this is edge. Watch physical premiums in key regions. If spot drops, but premiums hold firm, the drop is paper-driven theater. Watch inventory reports and withdrawal pace. Slow grind is one thing. Sudden acceleration is a different animal. Watch policy around export controls, strategic reserves, critical frameworks. Those aren't opinions. They're levers. Watch corporate deals in mining, offtakes, royalties, equity stakes. Companies don't structure those for fun. They structure them because they're terrified. And watch the gold-silver ratio, not as magic, but as a sentiment gauge. If silver outperforms violently, it signals the market is pricing industrial tightness and monetary interest at the same time. Before we end, 2 questions. Answer in comments. First, do you think governments will eventually restrict silver flows like they restrict certain energy inputs? Yes or no, and why? Second, if paper price drops next week, what do you check first to separate real from fake? Premiums, inventories, or policy? Go. Now subscribe, because the next phase of this supply war won't announce itself politely. Here's the line we repeat. We're not gambling. We're measuring. If supply tightens, we expect stress. If stress rises, we expect volatility. If volatility rises, we expect opportunity, but only for those who positioned before the crowd arrived. One more thing. The most dangerous moment in a tightening market is when everyone believes it's back to normal. That's when supply chains relax. That's when shorts get confident. That's when the next shortage hits without warning. And we're entering a stretch where thin liquidity, policy shifts, and physical demand can collide again. So don't watch the chart like entertainment. Watch it like a storm map, because the sky is already darkening. And the next headline won't say silver is volatile. It'll say silver is unavailable.